Hello, Smart Money Tree podcast listeners. Welcome to this week's show. My name is Kirk Chisholm, and I'll be your host. So today I'm talking with Tony Greer. How you doing today, Tony?
Say again? Oh, great to be here. Thanks, Kirk. Sorry, I'm just getting my system set up here and I'm working on the audio, but I can hear you. I'm all good.
No worries, no worries. Well, good. So Tony, tell us a bit about your background before we dive right in.
Yeah, sure. I kind of divide my career into two halves. I spent the first half, more or less, as an FX and commodities trader. I spent the bulk of that time at Goldman Sachs trading metals and commodities in the J. Aron division. After the firm went public, I tried an opportunity to start a trading firm on my own. That was an amazing experience and was basically an 18-month break-even exercise. And then I wound up getting a job on the street via my network in the equity market as a salesman in equities and did that for 10 years. And the one thread that was the sort of thing that overlapped both halves of my career was that I write about markets. I've been writing about markets for like 25 years now. And by the time I left the equity sales business, I had a list of 1,000 subscribers to my daily note, which started off with one guy and grew organically. So that was really exciting. And then I took it to a subscriber model before Election Day in 2016, ironically enough, when Donald Trump won his first administration, with the idea that the world was going to change dramatically with a Trump win. And knock on wood, I just started my ninth volume of the Morning Navigator, which is the newsletter that I publish 3 times a week, and I take great pride and joy in doing. So that kind of brings us up to date, I would say.
Nice.
Yeah.
Um, yeah, and we're actually taping the morning after Trump won his second term. So that certainly we'll get to that here because I think that'll be of interest to people for sure. Um, so interesting. So I'm curious before we get into like recent stuff. So you're a trader. You say you started for 18 months and it was basically break even. I would have thought you'd be minting money. Like why to be break even running a trading firm?
Are you ready for this?
Yeah.
It's a prop trading firm that sat down in March of 2000 to trade tech stocks
Wow.
electronically, right? So we basically defined diving into a bubble head first, and we were diving into a bull market thinking that it was going to be the continuation of a bull market at the highs. And we were able to adjust to the idea that it was going down from March of 2000 pretty quickly. If you may remember, that was the absolute peak of the first peak of 5K in the NASDAQ, and the thing got halved after that. Um, so I guess that experience was, something that was really, really treacherous to trade. And we spent like the first, I guess, half of the 18 months, like, just trying to break even, like, making some money and doing okay. And then we spent the next 9 months literally like churning money and barely covering our commissions because it was so hard to make money in a bear market. If you're a trader, you know that making money in bear markets is much different than making money in bull markets,
Mhm.
much more difficult. And so that's why, that's the kind of, I would say, I don't call it an excuse. I call it, that's what the experience was like. And so we folded up that operation and everybody went on their way without any big financial loss or anything like that. We basically were, like I said, like a break even operation, but with the chance to be able to just sit there and trade the markets for a living. And that's kind of what I was going for. And since it may not have worked out, but the experience was the most valuable experience that I have. And trading stocks during the dot-com bubble, up or down, and reading sentiment and understanding the market moves and understanding the potential that markets have, that was that muscle memory comes back to me now, like with this sort of, Nvidia trading landscape and the whole AI thing. And that stuff is trading like dot-com bubble stocks up and down. So those have been where I spend a lot of my time, knock on wood, day trading and fairly profitably because volatility is amazing. And so that's why the experience was so valuable, if that makes sense.
Yeah. Um, So, a few questions for you. So, you mentioned a bear market's different from a bull market. Obviously, they're different. But when it comes to trading, how is that different? Because I would assume you could make money on both sides.
Yeah, you could definitely, you can make money on both sides. I guess what's different was that was the beginning of electronic trading, and it was much more transparent than it is now. There were back then there, if you looked at, you had to become a master of the trading montage, as we called it, which was basically the electronic image in front of you on the screen of the bid offer spread between, pick your high flying tech stock name, WorldCom, and you would sit there and watch which players were on each side and who had what axe to grind. And when you found the guy that had the most powerful order that was driving the market in a stock on any given day, you were able to front run the shit out of that guy and make a bloody fortune with your eyes closed. So that was where things were different. If you look at a montage now, it's not nearly as transparent. It's filled with a bunch of different ECNs, right? Electronic trading, ETNs, electronic trading networks, things like that. And the montage doesn't always show like which broker dealer is, the lead buyer, or which, what their how they represent themselves. Everybody's in a dark pool. Everybody is in, hiding their million share order with 100 shares on the bid, and the markets are much less transparent right now. So now you're forced to sort of change your price action judgment from, understanding that to purely understanding price and time, and that's kind of it. So it's a much different landscape for somebody that's really in the weeds of the trading.
Hmm, interesting. So, it sounds like it's a lot harder now. How do you navigate it now compared to before when you don't see the flow, you don't see, the volume that you're waiting on. Um, you probably have a lot more people doing it. So how do you navigate it now?
I go back to the charts. Everything that I do, Kirk, is a sort of calculated bet on a technical move. Essentially, like I've got to have a certain number of macro tailwinds to a long that I want to put on, but I also need it to be in a position where I can put it on with good risk reward. So a lot of times what I do is put trades that I'm tracking in my radar screen so that my clients can look at them and follow what I'm looking at that I'm bullish and what I'm looking at that I'm bearish, and see. Then for me to put on the position, I need it to be at a place where it's got to be good risk reward. So if something that I'm bullish is flying away above all the moving averages, I have to wait for it to pull back into the moving averages, and then I can put a stop loss below the moving averages, and with any luck, navigate into trades where the trend becomes your friend, and I can just keep moving a trailing stop loss up along with the market and ride that trend for as long as it goes. And then when, the markets turn and your stop gets selected and you're out, that's it. That's the end of the trade. But what's pretty cool about it is, I was very vocal in November of 2023. I made a really good call. I told my clients, stop everything you're doing and buy stocks with both hands. And I'm still in a stock market long, but my point was, that was a position that I started off saying, I think this lasts maybe a quarter or two. And it wound up, I ran the position for 11 months before I took profit and made 1,300 points. And then I told all my clients that over the summer ahead of the elections, market on the highs, this is a good place to take profit on that trade from November. And all of the alpha that my clients were, and me and I were able to capture just from having that structurally bullish call for 1,300 points. We were buying dips and selling rips, and we were in lockstep with the market because we had that underlying bullish call. So when markets backed off and prices came our way and everybody in the market's shitting their pants and the VIX is at 30 and the stocks look like they're about to curl over through the moving averages, that's when we show up and we're a buyer because we want to buy distressed bull market moves. And knock on wood, that was, a really great way to play things. And my clients are happy. And it looks like we might have another leg of the S&P rally to trade with the Trump win.
So what is that? Um, so you're making calls in a macro perspective. I get the 2020. I mean that in hindsight, it was kind of obvious. It was somewhat obvious when it was happening, but certainly in hindsight, what how do you how do you determine when you're getting in and out of a trade, whether you're bullish or bearish in a trend? I mean, we just had I mean, presidential year, fourth year of presidential year is usually pretty good. In stock market cycles, I forget the first, second, and third year. One of them is pretty bad. I think it was the second. I can't remember, but one of them's not good. But generally, like it follows a certain theme. So how are you making these calls? Like, how are you determining the trend is your friend or it's not? How does that work?
By reading the markets, reading them, and in a way that I began, I always followed the markets my whole life as a desk trader and as wherever I was working at a bank as a sales trader and everything. And when I broke out and launched my own newsletter and my own business in 2016, I created a spreadsheet because I had a lot, when you stop working for somebody else, you don't have to do any of the things that they need you to do. You just do what drives you and what propels you and which way your research is taking you and the way you want to feel the markets. And I created a spreadsheet that basically, follows the big macro drivers of the markets. And I'm talking about like, the stock indices, the S&P, NASDAQ, and Russell and Dow, and follows the VIX and follows Bitcoin and Ethereum and, interest rates and currencies and commodities and all, call it probably 25 sectors of the S&P that I selfishly choose. And I created a spreadsheet whereby I could watch their performance over a period of every week, every month, every quarter, and every year. And so that became the most valuable tool that I've ever had or ever created to my trading P&L, my trading success, quite honestly, because it became a study of what sector. See, I've always been a sports fan, so I love following data and following teams and following batting averages and goals against average and things like that. And so I turned the market into that, whereby every security has its own performance matrix. And I can follow what it's doing, from watching the markets every day on a daily basis. But then every Friday is my favorite time of the week. I usually like to get a workout in around lunchtime and then come back and get in front of the markets at 4 o'clock and crack a beer because I'm so excited to see how things finished on the week. And so all that data goes into my spreadsheet. I look down the list and see what's putting in a streak of several consecutive weeks. I overlay that onto the charts and see what might be recently breaking out or pulling back into support or something like that. But when you look at the markets in that sort of a matrix and get really, really comfortable with it, and now I'm talking about, I created the spreadsheet in 2016 and now I'm following it, granularly on a a daily, I just look at these screens, but on a weekly, monthly, quarterly, and yearly basis. And what gets ingrained in your head is what's performing and what's not. So it's the kind of thing where you get this general center of gravity about where things are versus each other. And that's a really helpful, I guess, piece of knowledge to have in your pocket when you're trying to prop trade for a living.
Yeah, it makes sense. I've kind of felt something similar. It's kind of like a sixth sense, if you will. You just kind of, you're in the
Yeah.
mix of it. You're in the soup and you're just like, all right, I can't explain it, but it's like, this is how it feels. And I'm sure there are ways to explain it, but like when
Yeah.
you do, it's just second nature, it's just gut reaction.
Yeah. It's kind of like I'll use the analogy where like you go on vacation and you don't know what you're in for, but you pick up a number of different memories along the way, and you kind of look back on those and they kind of form, help just generate, memories about other things. And just having that sort of knowledge in your head about like where something's going and where it's been, the trajectory of how it got to last sale, of how it got there, and just having that whole history in your trader's memory bank. Yeah, that's kind of exactly what it is. And it's been really, really, knock on wood, really, really helpful to my trading.
Nice. So
Yeah.
one of the things you mentioned was that volatility picked up and that helps. Now, for people who don't know, most people get afraid of volatility, but traders love it. So why is volatility important when it comes to trading?
Not to sound obnoxious, but it helps you make and lose money faster. And as a trader, you get impatient, right? If every stock, if the stock market moved a basis point a day, it would be really difficult to make a living trading it. If it moves 100 basis points a day, it gets a little easier. If it moves 1,000 basis points a day or 10%, it's like, oh, baby, this thing's in motion. It's going to travel a long distance. And like we used to say in as day traders during the dot-com bubble, if you can't pick up $1 or $2 on a couple thousand shares within a $10 rally, then you should probably be doing something else.
Yeah. Okay. Yeah, I mean, I know back in the day it was a little bit more stock specific, but now you've got all these ETFs, these leveraged ETFs, these inverse ETFs, you got futures, you got options.
Over the day options expiration now, right? It's like pure C4 underneath the markets every day. It's fucking mental, but it's pretty cool. It contributes to volatility and everyone's happy.
Yeah. Yeah, that's the interesting part is it's just just pure adrenaline, just people want the action.
That's what it
Um
is. It's like going to Atlantic City and playing against a dealer that's breaking every hand. It's a lot of fun. The table gets loud. It's like, yeah, this is the place to be, man. That's like a virile market. That's exactly what this market is like because it seems like an extremely healthy bull market that is going a lot higher.
yeah. Yeah, it's
Yeah.
interesting. It's funny you say that. Atlantic City. I remember years ago, I was in college, and for New Year's Eve, we were still at school for hockey, and we went to the casino. We're in Connecticut, of course, casinos everywhere, and never played craps before, so we were like, all right, we'll play craps. So we go sit down, and it was this monster run. This guy shows up, just puts down, $100 bill after $100 bill, and just stacks them up, and he ran the table for like an hour and a half. Like it was ridiculous. And I was like, I love this game. This game's great. It's like
Exactly.
first time I ever played. This is awesome. We're all making money. And then like he leaves and all of a sudden started going. I'm like, all right, we're done. Let's like
Yeah, exactly. There's nothing like a hot run on a gambling table. I'm a blackjack player, but whatever you're playing, I mean, I love to hear the craps tables going berserk for an hour.
Yeah.
There's really nothing like it when a table gets hot.
Yeah. Happened to me one other time. And I think it was the only other time I played craps and was with a buddy, but like I go once a year to gamble. So for me, it's just pure entertainment. Win
Oh
or
yeah,
lose, doesn't matter. The money would have been spent somewhere. So whatever, go with a few $100 and I'm good.
yeah,
Which is the cost of a dinner nowadays. But
yeah.
but anyway, so all right, so let's talk about recent stuff because that's important. We just had Trump get elected, leaving politics out of it or not. But what do you think is going to happen from here? How does the market see this? I know seems to be a good day in the market, but what is the thesis going forward of where things should be going?
Well, I think that, one thing that was clear was that right at the beginning of October, when he took a lead in the polls, the S&P went on a fresh breakout to a new all-time high I think it was through like 5,600 at the time, 300 S&P points ago, or 5,700, around there, whatever.
Hmm.
But the point is that was the market starting to telegraph a Trump win. And so what does that mean? All we got to do is get our trader memory book back and say, what did the stock market do under his last administration? Because this one's probably not going to be much different. And say that, whoa, it went from, I don't know where the stock market was, 1,200 to 3,500 or something like that during his last administration. So that was unbelievable because he did the low taxes, low regulation Ronald Reagan trade for the country and didn't get us into any new wars, and everybody loved that. So I got a feeling that the market's looking for the same kind of thing. I think it's pretty astounding the team that he's got around him. And I think that this is kind of more than there being okay, Trump is president, therefore these stocks are going to go up because I think there's a lot of emotion involved in today's trading. I think that a lot of people show up on their trading desk. They got the win, maybe that they were looking for, whether they were looking for it politically or not. They were looking for it as the reason to deploy capital in certain areas. Now, today, if you want to look at the screens and see the bank stocks, financials, names like Goldman Sachs, American Express, Morgan Stanley jumping off the screen in 10 and 12% increments on the day, which are 4 and 5 standard deviation moves, that's sending a message, right? To me. And that's because that's how I look at the markets. And there are so many sectors. I just want to move this so I can take a look. There are probably 15, I'm just guessing just from looking at my screens, there are at least 15 sectors of the market with 3 sigma moves higher today and the S&P trading up to 6,000, right? Now, that's bullish no matter how you look at it, right? Now, I would have thought that there would be some kind of a sell the fact Trump trade that would have shown its face already, where everybody would be so bullish the S&P would open up at the highs and everybody's so long that the market just sells straight off because all the buyers bought already. We have the biggest long futures position in the history of the equity market. So the boat is loaded. And that sell off never transpired. We came in today and portfolio managers said, buy every bank under the sun, buy Goldman Sachs, JP Morgan, buy, industrial miners, buy industrials, buy oil services, buy transports. And this stuff is all just taking up and gone. Now, that's not that for me, who's somebody that goes with trades like that. I'm going to be combing my closes today and see if any of these stocks that put in these huge moves just broke out of a new range or something like that. And those are the trades that I'm going to be tracking down for the next quarter or so.
Okay. Yeah, no, that's interesting. It's interesting perspective. Yeah, because it's been a very hot day all the way around. I mean, the coal stocks certainly are taking
Yeah.
off. There's a bunch. I mean, yeah, quite a
Everything,
few.
airlines, natural resources, energy, software. I mean, everything, when everything across the board is going up, there's not much of a rotation going on here. This is an all out rally. This is an all out rip your neighbor's arms off rally.
Yeah, this is interesting. Actually, the only thing that's not doing well is international
Well, because they're going to get
in gold.
sanctioned, and
Yeah.
what's gone on since before Trump was elected was the US was dramatically outperforming Europe, for example, as they deindustrialize and become a tourism center. But that trade is probably, with sanctions and, Europe, Russia, China, everybody else starting to pay the bills for the US, they don't have a chance, those markets versus the US. They don't have
Yeah.
a chance.
Yeah, that makes a lot of sense. That makes a lot of sense. So, um, I don't know. I don't know if you cover bond markets or fixed income, anything like that. How does that kind of play into your calculus?
Well, the credit markets are extremely healthy in that I'm just calling up the twos 10 spread here. I'm not ignoring you, but what I love seeing is that we've got an election unknown behind us, right? Nothing in the yield curve has changed. The yield curve is currently in positive territory, which is now in indication it's steepening now. Talking about twos tens, it's steepening now as a reflection of the Fed's changed policy stance. Interest rates are going higher, and the reason the stock market can bear it is because the data is getting better. If you remember, we just came out of a huge growth scare where we had to pivot the boat. The Fed had to change the interest rate boat from tightening to battle inflation to easing to, get ahead of this data that was weakening. And since we pivoted into that easing, the data has only gotten better. And so that's why the market looks at better data and higher interest rates and says, go, baby, go in the stock market. So as long as the economic data can support higher interest rates and the curve is steepening in calculable or at least, not violent fashion, non-volatile fashion, everything for the stock market is going to be beautiful.
So it brings up the question, because lowering rates by 50 basis points a few weeks later isn't going to change anything in the market in terms of fundamentals. It might change sentiment, but I mean, it takes 6, 9 months, 12 months for that to roll through.
If
Good question.
anything, the Fed is in a position to make another policy error and reignite headline inflation,
Well,
right? I mean,
that's
and
my
that's not my
question.
trade. That's Stan Druckenmiller's trade. Right,
Yeah.
right. He's short bonds. Paul Tudor Jones is out of the way of the bond market. He's in gold, Bitcoin, and stocks. Right, all the inflation hedges, and he'll take whatever he can get. I think that they're looking at it as we are, like Druckenmiller said, we are looking at, reckless fiscal expenditure. I think were the words he used, like no matter who won the election.
Right.
And now that it's Trump, he's going to spend like a drunken sailor versus Elon Musk, maybe cutting the size of and cost of government. And we'll see where it nets out. But I'm imagining that we're still going to continue net spending money like drunken sailors.
Yeah, no, I would agree. I don't think there's any way to not do that, and I don't know that there's a solution out of the quagmire that we find ourselves in. Right? You stop
Exactly.
spending, you go into recession, and if you spend
Yeah,
more, you blow the country. There's no way out. We're done. We were
you're
done.
exactly
Somebody said
right.
like we're done like 20 years ago.
Yeah, the only thing that you can do is be long non-fiat currency. Be long
Yeah.
gold, be long Bitcoin, be long the S&P if it's going up in dollars shrinking, you know what I mean? So things like that.
Yeah, I noticed the dollar's up today too, which is interesting.
It's a wrecking
Um,
ball. Rates are higher. The dollar's been trading lockstep with interest rates for a couple of weeks now.
yeah, it's very interesting. It must be a international rotation to the U.S. Maybe I don't know.
Could be.
So what's so you mentioned the inverted yield curve that is no longer inverted, or it's I guess it's on the line, right? Give or take a little bit. I haven't
Mhm.
looked at it lately, but last time I looked, it was right around the line. Um, how do you take that? I mean, we had this period, I think it was like 11 times that it caused a recession, and this time it hasn't really reverted back to normal, or if it is, it's just barely. Um, but how do you take that? Because we're overdue for recession. Everything's really expensive, and you may like that because you're more into the trend. But we are expensive as a market, and that doesn't go to the moon without consequences. So how do you think about that as a trader?
The yield curve had been inverted for that record amount of time, right, in negative territory. During that amount of time, we got two negative quarters of growth in a row, right? That is the definition of a recession. Period. End of story. That is what the market has been trading on since Christ, right? Two consecutive quarters of GDP negative growth equals a recession. When that happened during the Biden administration, like everything else they did, they came out and lied to everybody. They said, hey, we got economists that say two negative quarters of growth is not necessarily a recession. Nobody cares. Nobody cares about what the economists said about that not being a recession. That was the recession that came when the yield curve was in negative territory. And even the ding dongs on Wall Street that were so politically caught up in that idea that maybe this wasn't a real recession because the admin said so, they went with that idea. And that's what they went out and told people. So that was a little bit that was a little bit wild as a trader to see an actual recession happen. The bond market, yield curve starts steepening coming out of that. And the admin is arguing that it wasn't a recession, that never happened because they don't want it on their record.
I know
Right.
that
So
was
it was literally unbelievable. And that to me was, yeah, the recession happened. Now we're crawling out, we're adjusting to a change in the yield curve, and it's probably going to continue to steepen.
yeah. I mean, the valuations don't seem to have changed. They seem to be exceeding all historical expectations for a long time now. Like it's not a recent thing. It's been going on for a while. People don't seem to care. The bond market doesn't seem to care about, the deficits or the debt. It just keeps plugging along, and it just kind of makes me wonder. Like, and I know you're not a valuation guy, but as a macro guy, like it makes me wonder. Like, does any of that even matter anymore? Like, value
Yeah,
stocks have
because
been out of favor forever because people just don't care about the data.
because the valuations aren't the one thing to me that I do care about. I don't care. Well, I guess I can't really say one without saying the other, but I do care about earnings. Right. And S&P earnings, if you look at the chart of S&P earnings, it goes from the bottom left-hand corner of the screen to the top right-hand corner of your screen in steep fashion. So like they're in a channel that like it's skipping across the top of the channel. The S&P continues to earn so much more and more money every year over year. So that's what, that's the benefit of being in the index. It's the best inflation hedge on the board. And if you get the sectors right, like you get in the semiconductor sector this year, and you get a 50% return in 1 year.
Yeah, it's crazy, crazy to think
Yeah, it's
about.
a crazy bull market, but it's a bull market.
So do you prefer to trade indexes or individual stocks, or how do you make that determination?
I have accounts that trade at different speeds, if that's fair to say. So I have like so if I throw in all three, I have a retirement account that I adjust quarterly and not ever at any other time. And then I have an investment account that I try to get into trades that are, with a reasonable 5 to 10% stop loss on the position. I expect that trade to last maybe 2 weeks to 2 months or something like that. And so I have an account there. And then I have where I trade mostly indices and sectors and kind of, maybe slower moving things compared to my account that I day trade in, my interactive brokers account, which is, a little bit like sitting at a blackjack table all day long, trading 25, 30,000 shares of NVIDIA in a single day. But that's where the money is. That's where the bread is buttered when stocks are that volatile and, you have the muscle memory of how they're going to trade on the open, how they're going to trade when they gap higher, how they're going to trade when they gap lower. When you get into all of that and have that history behind you, that's where the real bread and butter is made for the sort of trading P&L. And it's that being in the, okay, what's the trade today? Financials are breaking out. They're going to be gone. Why? Trump, the whole thing. Okay, buy those. Go along, go with the markets. Get into the trades that the market's telling you is going to work, and they work for. Today was a very easy day to buy what's up and have it go up further, if
Yeah.
that's fair, in the speedy account. You know what I mean? And then so some of the slower moving stuff, that's the stuff that I manage in the view matrix of my newsletter. Where I manage a P&L right in front of my clients so they can know the timing of the stocks that I buy and sell, or the sectors that I buy and sell, or the indices or the commodities. And knock on wood, I had a record year and everybody's happy.
Nice. So, all right. So, is there a reason why you do the three different accounts and instead of just, I mean, why wouldn't you just put it all on your bread and butter account if that's where
Because
you're
I have
making all your
I
money?
have different time horizons, like, and my having a 401k, which is the retirement account, obviously, but that's your long-term thing, and I have long-term, views on the markets that come out in my spreadsheet where I monitor things, just like I have short-term views, and if I notice a sector that's, putting in a string of, weekly consecutive weekly rallies, consecutive monthly rallies. I mean, that's the stuff that I'm also in trading from the long side in my day trading account. And so it's kind of alpha on top of alpha on top of alpha if you get it right.
Okay. Yeah, it makes sense. It makes
Yeah.
sense. Cool. So, all right. So if you're thinking about, if you're an investor looking to get into this field, obviously you've got a background, you've got a lot into this. Is this something just anybody can get into, or how should individuals be thinking about this with their portfolios?
Yeah, I do think it's something that anyone can get into, but like, any sport, you have to have like, the gene to care, to start with that. I don't think that any of this is either proprietarily perfect or anything like that, or can't be done 18 different ways, or, that's the beautiful thing about markets is that there are, and why it's so valuable to listening to other experts in the market is that different people, there's 18 ways to skin a cat on Wall Street, as we used to say, right? So there's people that have different methods of trading, different triggers for their entries and exits, and different ways of following fundamentals. And, once anybody develops their own way of doing something that's successful, they can ride that strategy out the rest of their lives and capitalize on it.
Okay.
If that's
Cool.
fair.
Yeah, no,
Yeah.
no, it's reasonable. Um, all right, so Tony, what else do you I mean, we've covered a lot today, but as we kind of wrap it up here, what are some final thoughts you can leave our listeners with, or some things that we didn't cover you think would be really important to know?
I guess I would say that I'd love to maybe just impart maybe my strongest views and the two things that I've managed to stay long for quite a long time and stay with is staying long gold and long the S&P. And knock on wood, those trades have been good to me, but also I think it's important, to have that exposure in your portfolio and maybe even, making sure that you get Bitcoin off the zero boundary in your portfolio as it breaks out again. Bitcoin is something to me that like, and I'm not a Bitcoin or cryptocurrency specialist at all, but I do have a trader's experience and everything looks like something else. And when a security like Bitcoin dies right in front of you and gets left for dead twice and then comes back to life, it's like, holy shit, this thing is for real. And then we traded Bitcoin right through the ETF launch where, everybody and their uncle put out a Bitcoin ETF and BlackRock is the biggest one. And if you follow the inflows coming into these ETFs, they are mind boggling and they never stop, never stop. And now that it's got Bitcoin breaking out beautifully technically, which is one of the most recent positions I've re-added to my pad, I think that that's something that could be around and sticking with us as a sort of hedge to fiat currency, which is continuing to get, bludgeoned every day in the West, certainly. So I think that those are, and the S&P, which is also another great, inflation hedge. I mean, I think those are the places that you need to be, and they've been good to my clients and good to me. And so that's kind of the way that I kind of look at the world, if that's fair.
Yeah, yeah, no, that's perfectly reasonable.
Cool.
Cool. So Tony, we appreciate you coming to the show and sharing your wisdom with us. Where can people find more about you?
Yeah, man, you go on my website, tgmacro.com. There are samples of the newsletter there if you want to kick the tires on it. You can follow me on Twitter at tgmacro. I do a really fun podcast with Jared Dillian called the Macro Dirt Podcast. We're about to record our 20th consecutive week tomorrow, and that's been awesome. We're on YouTube, Spotify, everything. And I also do a really fun podcast called the Oil Ground Up podcast for Clear Commodity Network, which is a network where we're trying to be kind of the leading amalgamator of commodity content in both following markets, written articles and mostly podcasts. So that's the projects that I work on. That's where anybody can follow me. And if any of your clients want to email me at tony@tgmacro.com with any questions, I'd be happy to answer.
Absolutely. Well, Tony, I really appreciate you coming to the show. We'll have you back on. I've enjoyed this. I think it's a good time to discuss this, considering the presidential election is over and we got a new theme for investors. So thanks for sharing your wisdom with us.
Yeah, man. Thanks for having me on, Kirk. I love the show and I really appreciate you having me on it.
Hey, Doug, did you hear? We're giving away free money. Well, I'll tell you about it in a minute, but before I do, there's a saying in the mining community, well, precious metals mining, that is. The saying is that if you want the best deals, you have to be in the room. Now, you're probably thinking, what does it mean to be in the room? Well, I'll tell you. Being in the room means that you're on the short list of people who get invited to be a part of the best deals. These are the deals that most investors will never have access to. You mean like IPOs? Nope, IPOs are chump change. Those are for retail investors, small potatoes. That's nothing compared to these deals. These deals would have you salivating to get access to them. Once you know they exist, you will never look at investing the same way again. I almost don't want to even tell you that they exist because it will ruin your thinking of how the investing world really works. Now, you might be excited that these deals exist, but you only have access to the deals if you're an insider, or in the room as they call it. Now, as loyal listeners to the show, I'm going to give you a chance to be in the room. Money Tree Investing Podcast has created the Insiders Club. This is a community of our show's members who are loyal listeners of the show and want to get more out of their investing experience. Being a part of the Insiders Club gives you insider status for upcoming events and webinars, discounts, free stuff and books, and influence on the future direction of the show. This is a great opportunity to join us as we expand our content and services. Oh, and did I mention free money? Yes, in the next few weeks, I'll be giving away free money to our members of the Insiders Club as my appreciation for listening to the show. Now, there's no cost to join the Insiders Club. Just go to moneytreepodcast.com/free money today to join the community. That's www.moneytreepodcast.com/free money. I hope to see you in the room.
All right. Well, that was a great interview with Tony. Really appreciate him coming to the show. Now we're into the panel portion of the show. We have our very own Phil Weiss. Hey, Phil.
Hey, Kirk. Good to see you today. How's it going?
Yeah, good to see you too. Well, it looks like we're once again just the two of us. I don't know if it's the election that caused people to spin off into left field, but we only had a few. We only had one panelist on each time, so we're getting some conflicts here around the holidays. Anyway, let's dive right in. So, what are some of your thoughts from the interview, Phil?
The overall thing is I'm not a trader. So the approach that Tony talks about, while it can work for some, it's not something that I do or that I recommend for my clients because trading involves lots of activity. You have to be right a lot of times because you're making more decisions, and it involves risk. And I think when we're investing for retirement, those are the type of things that I really want to try to minimize as opposed to taking all those chances.
Yeah, and that's actually, I mean, you said you're not a trader, and I've learned a lot from interviewing traders over the years. I'm not a trader either. But what I've learned is definitely a different mindset about risk. And I think that a lot of people think of traders as or trading as a risky endeavor. In many ways, it's not, if you do it right. So if you're just some Yahoo that's so local retail trader that's got your portfolio and you're saying, hey, I'm going to become a day trading millionaire. Good luck to you, because you're probably going to lose all your money. I mean, that's probably more standard than anything else. Now, if you take it seriously, you turn it into a profession, that's completely different. There are many principles when it comes to trading that will help you have a lot of success with your trading. But if you just look at it and say, I'm just going to start picking stocks for a living, good luck. These people practice for years and years and years to get good at it, and even then, it's hard. It's one of the hardest things to do in investing is trading. But some people are extremely good at it. Now, you have to change your mindset because the way Wall Street trains you is basically buy and hold, buy the dips, like all this stuff that they teach you. And that's valuable as an investor. It's not valuable as a trader. As a trader, you don't buy the dips. You sell the dips, right? You hit your stop loss, you're out, right? You know your stop loss going in. I'm going to make 5% of the trade or I'm going to lose one. If it goes down one, you're out. If it goes up five, you're out. Like, you've got principles and rules that you follow based on what you see as the thing. Now, you could be a swing trader, you could be a day trader, you could be, all these different types of trading. And there are different styles and different rules for each, right? So if you're a day trader, you're in and out, right? You're not holding overnight. You're doing certain things. Whether you're arbitraging, whatever it is. Swing trader, you're looking for a longer run in your trades, and I think depending on what your interests are, you just have to be really good at that thing. And so I just want to warn everybody that day trading, yes, we do interview people that make great returns on day trading, but they're also professionals and experts who've been doing this a long time. And so you should never go in with all your money. It's like going to the casino, right? We talked about the casino. Like, don't go in with all your money and put it all on black and just say, all right, I hope we win. Just, you have to have principles. You have to look at trading probabilities. You have to look at a lot of different things. And Phil and I were just joking about the craps story before the interview, but like, trading and gambling actually have very similar principles. Let me reframe this. Successful trading and successful gambling have principles that you follow. You could just go to the casino, like Phil, you've been to the casino before, right? Like, how do you trade?
Yes.
How do you gamble?
I go in and I kind of say, here's how much I'm bringing today. And that's the maximum I'm willing to lose. And if I lose, that was what I paid for my night's entertainment. If I win, it's nice. You guys talked about playing craps. I like to play craps. It's fun. I don't go do it that often. It's probably been a few years, I think, since the last time I did it. I actually learned how to play craps at my cousin's bar mitzvah. They had a casino theme party and they brought in tables. And so I learned how to play without putting money on the line. So I understand. And it's a fun game because in craps, you're really not, it's kind of everybody is on the same side. I mean, yes, you can bet against the dice, But for the most part, everybody's on the same side. And if you get somebody that gets hot at the table, like everybody's yelling and cheering, and it's a lot of fun.
Yeah, that's my experience too. I mean, in my experience, when you're when you're doing that sort of thing, it's about the fun. Like when we went the New Year's Eve time, we were just having a blast. We just went and just, I mean, yeah, we won. It's more fun when you win, but I've gone and I've lost and I've still had a bundle of fun. But like Phil said, you go with a certain amount of money, right? If I think about it, if I have a night out in the town, I'm going to spend a certain amount of money, a few $100, whatever it is. I'm going to go out for dinner and drinks, maybe go see a show, whatever it is. Like you have a certain amount of money you're going to spend. I just do the same thing at the casino, right? Like my whole rule was always go with like $100. Just go with $100, just have a good time. If I lose, so what? If I win, so what? I'm not shooting for the stars. I don't need the rush, right? That's why people go and they need the rush. They need the action. I don't need that. I just go to have a good time. Just kind of hang out and just see some action, but I'm not trying to break the bank one way or the other. And so if I lose, I'm not disappointed. If I win, I'm not thrilled, but I had a good time because it was just fun hanging out with a bunch of people doing the same thing. So, um, you know, that $100 rule's changed because now a night out is a lot more expensive, um, just for the
So are
dinner
the
and drinks alone.
so are the limits at the tables.
Yeah, I know. I'm sure those have changed too, but at the same time, a lot of them are giving you free drinks too. So you're kind of balancing it out. They're not giving them free food unless you win a lot of money, I suppose, or lose a lot. But yeah, if you spend enough money, they'll probably comp you. But I'm not spending that much money.
Either.
So, um, but yeah, so I guess the thing is you just have to think about it as how are you going in? What are your rules? How do you measure your risk? Right? Because gambling is the same thing as trading. It's just measuring your risk and measuring your reward. I can make 3x or I can lose 1x. And what are my probabilities, right? And you look at blackjack, you look at craps. Those are really two of the best. They say, what is it? Craps is the best odds in the casino.
Yeah.
Yeah. I don't know how they mod that, but certainly blackjack is one of the better known ones that you can quote unquote game, so to speak. Craps you can't really game, but the odds are good. But it's what it's all about. Just go and just have fun. And if you're really good, then maybe there's some other ways to do it. But I'm not an expert roller, so it's like whatever. Oh man. So but I did want to, I mean, we're a few weeks after the election, so I did want to talk about this with you, Phil, because I think people are talking about the Trump trade and reality versus fiction, and I really wanted to kind of get into that. So what are your thoughts on the Trump trade? Where do you think things are going from here on out for investors?
So it's interesting because I heard Tony talk some about the Trump trade. And one of the things that he talked about was energy. Well, the truth is that energy wasn't a good trade while Trump was in office. Maybe it was initially, but energy stocks actually went down while he was in office. They went up while Biden was in office. We don't know what's going to happen. I mean, in general, I think the markets reacted positively overall. I mean, I know we've had a mixture. We had a big rally up, and then the next week we went down some, and this week it's been a little bit of both. But we have the likelihood of lower corporate tax rates. We have the likelihood of deregulation. Those are positives for corporations because both those things can increase their earnings. So that's a market positive. The other side of the coin is what's going to happen to interest rates because there's some things that we've talked about that are inflationary. And if we have inflation, we've seen interest rates have gone up a little bit. The yield curve has flattened out some. That can be negative. It's not always what we think is going to happen isn't always what's going to happen. I'll go back to energy for a second. And so why did energy prices go down while Trump was in office the first time? Well, it's likely because a more friendly policy towards drilling means more oil production. More oil production means lower prices, and lower prices are generally bad for oil companies. So even though we think about and it's like, and I just talked about inflation, right? So that could also help to counterbalance inflation, right? Because we have lower oil prices. Look, I remember when I was an oil and gas analyst, everybody wants to talk about oil prices because it's one of those things, the prices are broadcast on every street corner. You know what you're paying. And when you see the price go up, you complain. You like it when prices come down, but we're all aware of what we're paying for oil. We don't know why we're paying that always, but we know what we are paying. So it always brings a lot of discussion. But think about it, if we have more production, that means that can be deflationary, right? Because oil prices should come down.
Yeah, it's interesting you say that, Phil, because I was thinking about this the other day. If you think about different industries, right? Like you said, energy, you think it's positive for the energy sector, but it didn't do well when Trump was elected the first time. I remember when Obama was elected and gun manufacturers went through the roof. And here's an anti-gun guy and was trying to destroy the basically the gun sector with policy. Some of it more overt, some of it not. But but the gun stocks did really well, right? And you think about Obamacare, he instituted Obamacare, and you think, oh, it's going to destroy the medical system. What happened? Medical system profited immensely. Hospital stocks went through the roof, healthcare, insurance companies, they all made bundles of money off Obamacare, which was supposedly supposed to reduce costs. And what happened? Costs went through the roof. They're higher than they've ever been, and it's astronomical. And yet, it in large part it was because of the regulation that was instituted, where everybody was still allowed to make a lot of profit, and so they didn't care about the price, and so no one's managing the cost. Um, and yet, when Obama was elected for gun makers, people were afraid, so they went and bought guns, right? So I think what happens, and it's not a knock against Obama, it's just policy, right? And so when you have people with certain policies, what I find is things tend to be almost the opposite of what you think. For many reasons, right? If they're anti something, usually that thing does well because they're thinking are either A, there are going to be fewer competitors, which gun manufacturing, there's really only a handful anyway. But there's either fewer competitors like banks, like, oh, we're going to institute some really high regulatory environment. Great. Well, that means it's less competitive for the big banks because the smaller banks have a hard time competing, right? So you get a lot of this when you get government regulation, you get a lot of oversight and you get a lot of unintended consequences. I never would have thought that the healthcare and the hospital stocks would have done well, but they've done gangbusters. And so, I think we just have to be mindful of that. What else do you think is going to be impacting the economy? I will say one thing before I finish the question is go back and look at the day after the election when Trump was announced president-elect. Look at the performance of stocks. What were the best performing stocks, Phil? Do you remember?
I mean, I do think energy stocks benefited initially.
They did okay. Not the best
Um,
performance.
yeah, I would assume that tech did well because of the thoughts about less regulation, because there's a lot of pressure on the tech industry.
Okay, but definitely not. This is one that nobody's going to guess.
Okay. I didn't look at it that carefully. I know that the market went up a lot, but I didn't look at it that carefully. So
banks.
Right, deregulation, right?
Banks went up like double digits, like 14, like some of the large banks were up like 14% or some crazy number.
That's right. I do remember that now.
I remember looking at them like, why the heck are bank stocks up so much? And I actually just got off an interview with John Palmer from PL Capital, who specializes in small to mid-size banking sector. I've followed them for years. They're phenomenal. They're a niche, very small niche kind of player. But they do a lot of activist stuff with banks. And I was talking to him. He's like, banks are absolutely going to explode. And we were talking about why. And so definitely listen to the interview. But it's one of those things where I haven't heard about banks in years. And why the heck would you invest in banks? They're just low profit margin businesses. But the way he was explaining it, they should start to explode for the next 5 to 8 years. And it was interesting. And I was like, huh. And that makes a lot of sense. So Trump gets elected and bank stocks, first reactions, they go up like double digit returns. I don't know whether the gun sense because I don't really follow banks, but it was an interesting perspective to see how the market perceived the election. And so I'm curious what else you see on the horizon that investors can think about for the election coming up.
So one thing I think it's going to be really interesting, you started to talk about healthcare, but let's get a little bit more narrow in healthcare. And the word is that Robert Kennedy is going to be in charge of Health and Human Services, and so he's known as an anti-vaxxer and all that. And so all the a lot of the companies that are big in the vaccine area, their prices really took a big hit. And so it'll be really interesting to see if the market's initial reaction to that is in line with what actually happens. Like I said, when we had the first term, energy stocks initially were up, they ended up lower because we thought it was good for energy. Well, this time we think this is bad for the vaccine makers. Let's see what really happens. In the tech area, it'll be interesting to see, to me, there's been a lot of talk about regulation because you've got the big players have such dominant market share, and we don't have a lot of antitrust in the way that gets in the way. And so you would think that the push that had started to happen on possibly breaking up some of these companies will be interesting to see where that goes. Right. I think that if I'm thinking where it's positive, I mean, it looks like it's positive for crypto, right? Because, you know, Trump endorsed crypto. Like he even talked about maybe having a crypto reserve and less regulation in crypto could certainly help that. And crypto's really reacted very positively to the election. It'll be interesting to see what really happens because our initial reactions aren't always what happens in the end.
Yeah, I agree. I think my first reaction is healthcare is not going to do very well. Like you said, the vaccine makers, RFK is an anti-vaxxer. I do want to make one point because I think we all get susceptible to this. Kennedy is not an anti-vaxxer. He's actually made this point clear many, many times. He's not anti-vaxxer. He has an issue with the construct around them, which I actually agree with. Like, there's nothing wrong with vaccines. Like, I have kids. I allowed my kids to have vaccines, but I altered my schedule because at the time you were just shoving a whole bunch of vaccines into the kid at the same time. And, oh, we got this new vaccine. We're going to put them all in one. I'm like, no, like you just tested this thing. No, I'm good. Give me the one that you've been using for 40 years that we have data on. I'm okay with that. Right. You've got 40 years of data. Any issues? No. Okay. Let's use that one. Why do I have to use this new thing that you came up with because your patents ran out in the old thing? Like, I mean, I think the pharma space needs to be overhauled. I think I mean, I think we all have seen what happened with COVID and it was a shit show. And frankly, I think I'll say the word corruption in the space. I think it needs to be cleaned up. But I don't think Kennedy is anti-vax. I think he has an issue with how it's being pushed on everybody. And do we need 72 vaccines or 3 enough? Like there's questions which I think are a good question to ask, but I do think this is an interesting opportunity. So if people think that the pharma space is going to sell off, initially that's my reaction too. I think the pharma space is going to get killed. However, I also think that the pharma space is very resilient and it's basically built into the fabric of our healthcare system. I don't think it's going anywhere in 4 years. So maybe what happens is they become more efficient. Maybe what happens is they find ways to make it more insular from competition or whatever happens. I don't know what's going to happen. It's kind of like the healthcare space when Obamacare, it was going to save all these costs and all these healthcare companies are going to drop. No, they went through the roof because they made tons of money. And I think even though initially my reaction is the same as yours, like maybe the pharma space will get hit. Maybe it'll get hit, but I suspect that probably beyond my suspicions that they're probably going to do very well because they'll find ways to make it work, right? They're not going to just be like, all right, we're folding up shop. We're going to stop making, pharmaceuticals. Of course not. So I do wonder about things like that. And I do think that I will say that I do like what Trump is doing with his 3 to 4 minute videos where he's coming out and saying, here is my policy. Here's what I'm going to do. I think it's great marketing. He's a promoter. Like that's his skill. He's doing a great job promoting his policies and what he wants. He's not allowing the mainstream media to take the corporate media to do whatever they want with it. He's saying, here's my policy. It's very clear. 3 minutes. Watch it. You may agree with it or not. That's a different issue, right? But I like the formatting of here's my policy, here's what I'm planning on doing. And I do think it clears things up and allows people to go and watch the video and know exactly what he's saying. And like I said, you might not agree with it, and that's okay. But I think the clarity is important because we've had the last 8 years of lack of transparency in corporate media, which is still happening, but less so. But one thing I will say about tech, Phil, I noticed and I wish in hindsight I had put more credibility into this. I don't know if you remember, but maybe a month before the election, Zuckerberg bent a knee to Trump. I don't know if you remember this, but he came out and basically said, "Yeah, the government made me do these things." I think of that as bending the knee. He came out and basically called it out and said, "Well, the government made me do these things." Oh, okay. You're saying this now? Like, what about 4 years ago? Did you say it then? No, you said it because you saw the numbers probably, and you said, all right, Trump's probably going to be elected, so I need to bend the knee and just and culpability and just say, yeah, sorry, it wasn't my fault. Now, granted, of course it was because you could have stood up 4 years ago, but he didn't. Regardless, it doesn't matter. But I think what I'm seeing in big tech is they're starting to quote unquote bend the knee and just say, all right, we realize that we're in trouble if we don't kind of go along, even though we don't agree with you politically, we're going to kind of go along because we don't want to get shut out. Um, but it's interesting because there's always these two sides, right? Like, because the Biden administration went after antitrust monopolistic behavior with big tech, right? They were going after Facebook with Instagram and Google. It didn't go anywhere. It's still ongoing, but they definitely initiated the process. So I'll be very curious to see what happens because I know the Republicans have complained about them going after them because of big tech kind of manipulating the algorithms. I wonder if they'll kind of make friends and kind of figure it out, right? Because big tech is not going anywhere. Trump's not going anywhere, so they have to find a way to get along. And I think that's probably good for the country anyway. I think the tech really shouldn't be manipulating the data. I think it should be more open source where people can see what's going on. But maybe AI will change that. Who knows? But what else do you think what else do you think is going to happen in the short versus long term? Because I think the market's gone up way too much, way too quickly, and I feel like it's kind of like a sugar high that's coming off right now. So I don't know. What are your thoughts, Phil, for the rest of this year and maybe even next year once he actually takes office?
So one thing I want to point out before I get to that is just when you're trying to think about what else could happen, it reminds me of listening to Howard Marks, Oak Tree Capital. He always talking about second order thinking. Like this is what everybody expects, but let's try and go a little bit deeper and figure out what it could lead to. And that's really important. We don't want to just take everything on the surface. In terms of the near term for the market, my expectation would be, and look, I don't know how much value it has because I'm really just kind of guessing, right? Because none of us really know for sure what's going to happen. But I expect that normally the market does well. When it's having a good year, it continues to do well in the last couple months of the year. So I wouldn't be surprised if the market continued to move higher into year end. And then as we get into the new year, we'll see what happens with interest rates. Like right now, it seemed like the Fed might not raise rates in December, and everybody thought they were going to. But the last that we heard from Powell made it seem like they're not going to raise rates in December. And where do interest rates go? That's a question to me. I would expect that it'll slow down a little bit because not all roads point to the sky. And so it feels like the market is due for a pause. And we had a good year last year. We're having another good year this year. I know 22 was bad, but it doesn't seem like the market just can't go up all the time. And valuations have gone up, but like I said up front, if we have some of these things that benefit corporate earnings, I mean, that does impact the market valuation, right? Because if companies get better earnings because they're paying less taxes and regulation or the lack of regulation, right, or deregulation, however you want to put it, allows them a little bit more freedom to do some of the things that they want, and they can make more money. Well, then that does have the other impact on valuations. I know I can look at different market pundits and get different views. Most are taking this as a more positive thing. I think that's kind of the consensus, and I always worry when I see a consensus. Is most of the consensus seems pretty broad, and at this point, for most of the strategists that you look at, the consensus is pretty broadly positive. That always gives me pause when too many people are going the same way. What are we missing?
Yeah, that's always a good way to look at it. I agree, Phil. When everyone's on the same side of the table, it's always a good idea to take the other side of the trade. I was just, as you were talking, I was pulling up the 1 month performance because we're not really a month, but the 1 month performance of different sectors in the market in the S&P 500. And the ones that stand out to me, the financials have done very well. Healthcare, specifically drug manufacturers, have done the worst. Beverages, the non-alcoholic beverages have done very poorly. Um, Technology's been a mix. Uh, Software, Microsoft's down, but like all the rest of the software are up. Apple's down. Nvidia and Texas Instruments, and Intel are the only semis that are up. Everything else is down a lot. Um, if you look at oil and gas, it's kind of like it's mixed, generally good, but mixed. Basic materials down, utilities down, a lot of the other stuff. Aerospace and defense is down, which is weird, but I guess that's kind of coming from an anti-war stance, so that makes sense. Telecom's done well, consumer. So it's kind of an interesting mix, like real estate, consumer cyclicals, kind of a mix. You've got Amazon, Tesla have done well, but like everything else, most other things are down. So it's an interesting mix just to look at, and I'd highly recommend going to like there's a website called FinViz. You can see kind of this heat map of what's doing well and what's not. So it gives a good indication. I mean, like I said, this is last month, so it includes a little bit before the election, but it's just a good way to look at where people think the market is going to go. I mean, if I just look at the last week, it's not good all over the place. But I think it's good just to kind of go back and just reflect on how the markets initially reacted, and then just be mindful of those areas that have done well and say, all right, are there opportunities going forward? Yes, I know in the last month, the banking sector has looked really good, but I also think that, like you said, I mean, Powell came out and said, well, maybe I'm not going to drop rates. I mean, he's been doing that for the last few years. That's nothing new. I was surprised he dropped it 50 at once, and figured, well, okay, that's fine, but that's a little surprise. So we'll see what happens. I mean, Trump's going to push him to drop it. Maybe that's why he didn't drop it, because Trump said, because Trump's a low interest rate guy, right? He's a real estate guy, wants low rates. So my guess is he's probably pushing for that. And Powell's probably trying to stand his ground, saying, well, I'm not going to do what you tell me to do, as if he didn't already say he was going to do it. So it's kind of like, all right, come on, buddy. So I don't really know what's going on behind the scenes, but when Jay Powell comes out and says, I'm not stepping down no matter what Trump says, I didn't hear Trump call him to step down. He just kind of called that out. He preempted it and said, I'm not stepping down. I'm like, wait a minute, what did I miss? Did I miss some news? Because I didn't hear Trump say he was going to fire him. So anyway, there's all this politicking going on, and it's always entertaining for me because I just watch this stuff, and you just watch outside and you see what's being said. You're like, I must have missed something. There's some behind the scenes stuff going on. But it will be an interesting month and a half. It's usually a soft market historically up until Thanksgiving, and then things should pick up from after Thanksgiving until probably early January. Things should pick up. So the Santa Claus rally at the moment seems in full effect. So we'll see what happens over the next week. But yeah, I'm excited for the opportunity at the end of the year. I think there'll be a lot of good stuff. Cross my fingers. Anyway, we got to wrap it up here in the interest of time. Phil, final thoughts from you, and where can people find more about you?
So the one thing I'll say, if we get back to, what Tony was talking about, like I said that trading is not my approach, but whatever your approach is, you have to think about having a process that you apply consistently, because that's really what gives you your best chance of success. It doesn't mean you're going to be successful, but if you have a process, it allows you to see what you're doing right and what you're doing wrong. If you're always kind of making changes and making adjustments along the way, it's really hard to know what leads to success and what doesn't. So in that case, you can have success that's just luck. So have a process that you stick to. I think that's the most important thing that you can do as an investor. As for me and where you can find me, I know that experiencing big life transitions can be stressful. My job is to help empower women facing new beginnings with the financial knowledge and tools they need to make self-assured decisions. My firm's Apprise Wealth Management. We'd love to get to know you. If you're facing new beginnings, you can take our Flourish Through Life's Big Changes assessment at apprisewealth.com/assessment. to discover how ready you are to embrace and thrive through your significant life transition. You can also sign up for our blog. Thanks for having me today. Enjoyed the discussion as always.
All right. Thanks for coming on, Phil.
That's the show for this week. Thank you again for joining us on Money Tree Investing Podcast. My name's Kirk Chisholm, wealth manager of Innovative Advisor Group. We don't just manage your wealth, we make your life better. You can find more about me at innovativewealth.com. And of course, you can find me every week here on this show. You can also check out our show at Money Tree Investing Podcast. On our website, you'll have access to the show notes, resources, and the archive shows. Please remember to subscribe on our YouTube channel for immediate access to the new shows when they're released. When you subscribe to the show, it allows us to get access to some of the top minds of investing in personal finance. While you're here, please leave a comment and question if you want us to address it on the show. Have a great week ahead, and remember, no one will care about your money like you do, so invest in your life.